Welcome to the July 18th, 2022 Advance Report from McGowan Group clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman, with your weekly fast-paced tour of the global financial markets. Boy howdy, what a week. I'm President, McGowan Group Asset Management, a team of 10, the team that cares, serving over 600 families right here from the Crescent in Dallas. Be sure to set your time for your Zoom meeting to update your portfolio, and I'll show you why. Here we go. This is CPI, that's inflation for consumers, going from a low of 0.1, and this week's big headline, 9.1% year-over-year inflation, bigger than expected. Federal Reserve administering electroshock therapy, jolting the markets. Here we go. In this case, Fed funds rate in 2017, 2018, in this tightening cycle, went all the way to 2.5%. The base rate for lending, that's the cost of capital, the overnight bank lending rate. And in the pandemic, they took it to 0. Now, 1 3/4 is the base rate. That's after the increase in June of 3/4. Now, the Federal Reserve is actually projected to take that rate from 1 3/4 up 1% July 27th, and then up another 0.5% or 0.75% the next meeting, getting to 3.25% for the base rate cost of capital. Now that's good for a money market because it means money markets will eventually get to 3%. But does it cause a recession? The Atlanta Fed this week, and I'll give you the synopsis here, we had a negative quarter of real GDP growth because the economy grew at 7% dollar basis annualized, and inflation was 8.5, subtract it out, you get about minus 1.5. Atlanta Fed says it's going to happen again at a minus 1.2. The Bloomberg learned economists say, no, it's going to be 3% growth for this quarter. That's a hugely important July announcement coming up at the end of the month. What happens after that? A descent to about a little less than 2% growth. But you don't see any negative forecasts here, at least not yet, other than the Atlanta Fed saying inflation is going to temporarily exceed the dollar growth in the economy. That's a stealth recession. Here, I want to go back to 1978 through 1982. So, put your Calvin Klein jeans on and get ready for this. This is what happened to the S&P 1978. There had been a bear market 73, 74. And what happened as inflation went to 15% year over year? That's a huge increase. Federal Reserve, of course, relentlessly tightened even further than projected here. Well, that led to a brief recession and then a rally. 93% was the gain from the beginning of the inflation spike to 1982. Now, there are a variety of reasons like tax cuts and deregulation that caused 1982 to finally be such a good year by the end of it. But what did it not mean? It didn't mean a prolonged bear market cycle judged by here and here. And some of the multiples within the market right now are as cheap as they were back in the late 1970s. How did you make money back then? Well, during this period, it was all about owning the energy stocks as a portion of the portfolio. Now, how are companies actually doing? 24 companies out of 500 of the S&P have reported sales growth was 9%. What's that? That's not a dollar contraction in the economy, by the way. That's a different type of recession. Earnings growth down 2%, primarily the negative portion of that you see that caused it to be a -2 are the banks increasing loan loss reserves because the economy is slowing down. Well, we've got the rest of the earnings reports coming up, so each week we're going to brief you all the way through when the pipelines and the energy companies and the medicals have reported by mid-August. Those will have some positive reports. This is the S&P 500. Now, Minus 21% is the year-to-date return. Since the June low, right here, June low, well, it's about a plus 2% on the S&P. The question that traders are asking, was that the bottom? I can tell you from experience, trading experience, having been through at least 5 bear markets since I started 35 years ago, well, the peak of pessimism that we saw June 15th with the Federal Reserve administering electroshock therapy to jolt everybody, well, they're going to get inflation under control, evidenced by the commodities. It's already happening. And if they moderate that path, then you've set a major bottom for the markets. But there's already bargains. If you can think in terms of 3 years instead of 30 minutes, there are already bargains out there that make perfect sense with great forward internal rates of return calculated based on earnings and cash flow. Well, this is West Texas Intermediate crude, descending this week to as low as $92 from a peak of $130. What's good for the pipelines is you don't get demand degradation at $100 or below, according to our sources. That means plenty of demand, plenty of flow through the pipelines, and they've already pre-announced potential record profits and cash flow plus dividend increases. So that makes perfect sense. We'll see how the medicals do. And global high yield, as a result of all this, has descended, in our estimate, to about 75% of par value with yields of just under 10%. That category makes perfect sense if you think in terms of 5 years. 9% would be 45% plus a potential gain of 20% or more. That makes perfect sense in the high yield bond market because the Fed won't do this forever. In fact, they are now forced to define how far they'll go, and that is potential good news for the markets in July and September. I'm Spencer McGowan, President, McGowan Group Asset Management. We are grateful to serve our client families. Thank you for tuning in to Net Worth Media today and our efforts over the past 2 decades to educate clients and help clients make great decisions. That's the reason that we're here at YouTube McGowan Group, Apple Podcasts, Net Worth Radio, and networthradio.com. The Net Worth Media effort is designed to help you make great decisions and address value at risk of loss, fluctuation in the markets. Remember, if we talk about a security, doesn't make it a recommendation until you come down and get a plan from McGowan Group Asset Management, the team that cares. You can set a Zoom meeting or an in-office meeting at the Crescent, and we'll give you a written plan that encompasses what we believe to be the best allocations. This is a team of 10 devoted to you. That includes the research that you see each week from Reuters, from Bloomberg, and from the best sources. We always post links at networthradio.com for what we believe can help you make great decisions, the research that comes up. Now, the Net Worth Media effort is also designed to address cycles in the market, value at risk of loss. At networthradio.com, you can get the ADV form that shows, yes, we're a fiduciary, a registered investment advisor. It covers the costs of hiring our team to help you in the future ahead. It really helps to have an expert team on your side that you can reach by phone, email, and of course, a team that's here for you every week to address what's going on in the markets, because anxiety can often lead investors to make decisions that are either dangerous, chasing things, or selling things when they shouldn't. And that's a big part of our planning effort at McGowan Group Asset Management. Thank you for tuning in, and we look forward to serving you and your family in the years ahead.